I do appreciate the opportunity to share some of our thoughts. I think that initial question that 20% of the audience is headed to depression, I think is a good starting point to evaluate where we think the global landscape is going. And I do think there are a number of scenarios where we would head to both financial and emotional depression. But I think it's important to really think through the noise versus the reality. I think today there is so much negativity reported in the media that it's incumbent upon us to really think through beyond just the headlines and what are some of the structural dynamics that would head us either into a global depression or a path that may not be great, but certainly is not Armageddon. So I wanted to talk through what our evaluation is of those different scenarios, and then focus a bit more on what are some of the long-term structural changes underway that I think we're missing in light of so much focus on this high-frequency headline noise. And then I think the toughest job of all of us is the environment today is very different than the last 10 or 20 years. There are no longer risk-free assets to invest in. So even just to preserve the wealth of your stakeholders requires taking risk. There is no easy way out of the situation, and thinking through where do we think we're getting actually compensated to take risk, I think is a very important portfolio question that we need to think through. So first, starting out with that depression scenario, I think there are two scenarios which would lead to a global Armageddon. And if you believe in either one of those, I think you can basically save the rest of your time, go to the beach, enjoy yourself, because every asset class will be destroyed. There is very little that one can do to hide in an environment where China has a hard landing or the Eurozone splits apart. If you firmly believe that Germany will start printing Deutschmarks, that Italy would have a credit event, or that China faces a real hard landing, not 6-7% growth, but 3-4% growth, either one of those scenarios, I think, would send us into a global depression quite quickly. But thinking through those, I think it's fairly unlikely that we reach those, and I wanted to share with you some of our thoughts as to why we don't. The first is on Europe. There is an incredibly painful deleveraging process going on. It's a very complicated political structure in Europe that is making policymaking very difficult. It is likely that Europe faces a recession. It is likely that growth is weak for a number of years. They have been late to addressing a lot of the problems. So while the U.S. is probably 3 or 4 years ahead, and the U.S. still faces years of high unemployment and slow growth, Europe is probably even more challenged. But that is very different than saying it's all about to come unwound. And I think there's a couple reasons that we don't believe, or reasons why we don't believe that Europe basically implodes. The first is the poison pill built into the Eurozone system. For a country like Germany to leave would be even more painful than it is for Germany to subsidize a place like Greece. And there's a lot of political tension, there's no question. I think it was best summarized during the Euro Cup in 2012, earlier this year, when Germany was playing Greece. And in the stadium, you had the German fans on one side, the Greek fans on the other side, and the German fans had these huge signs saying, "Merkel paid for your tickets." And it's like, okay, fair point. The Greek side was, "Yeah, you're never getting your money back." So there is a deep-seated animosity that is being played out in European politics. But at the end of the day, it's in the Germans' best interest to stay in the Eurozone. Think if Germany left, it would be the last BMW or Mercedes that they ever sold to a non-German. If Germany left, the Deutschmark, the new Deutschmark, would go up 50-70%. Industry would be uncompetitive overnight. There would be a massive recession. Initial estimates say maybe a 10% of GDP loss the day that they did it. Industry knows it. The unions know it. 80-90% of the parliament knows it. So there are some extreme groups, but they make up maybe 5-10% of the German population. So the core of Germany realizes that it's painful to buy the Greeks tickets to Euro Cup, but if they don't do it, the cost is even larger. And then the other side is the Spanish or the Italians. People say, well, why don't they just leave, devalue their currency, and then they can export their way out? if Italy or Spain left the euro, their currency would be completely debased. All of their liabilities, which are in euro, would be like the Asian crisis all over again. They would have liabilities in euro and revenues in a domestic currency that is worthless. They would be insolvent, corporate bankruptcies, government bankruptcies. It would be incredibly destabilizing. So as painful as it is to make these reforms, these countries are better off kind of holding together than they are leaving. The other very important factor is they have the ECB, which can print money and ultimately provide an unlimited amount, which Draghi has basically said they will do, an unlimited amount of liquidity to prevent a vicious cycle from occurring. The last factor is that Greece is terminally fiscally insolvent. It either has to be permanently subsidized, leave the Eurozone, or another restructuring. But Spain or Italy are not in the same league. They have challenges. Growth is anemic. There's a lot of structural problems, but they're nowhere near the extreme situation of Greece. And I think that's a distinguish that the media doesn't make all the time, that Greece, yes, is fiscally terminal, but Italy or Spain have actually made a number of reforms, and in many cases, this crisis has been a blessing in disguise in that it has actually forced changes of government, it has forced reforms. Without a crisis, politicians don't act. You see that in the U.S. There's no fiscal crisis because U.S. Treasury is at 1.5%. What happens? Politicians do nothing. There's a crisis in Europe. Politicians have actually made some very important steps. And I think often unrecognized is that previous crises in Europe have actually triggered some very important long-term reforms. And just looking at future obligations of pensions, future obligations of medical, it's I don't think often recognized that actually because of the crisis in Italy over the last couple decades, they have done the tough reforms that the US, the UK have not even begun to address. And this just looks at the net present value of all the future liabilities over the next 30 years, basically discounted to today's valuation. The US has over 200% of GDP liabilities, medical and retirement issues that we have not even begun to address, and this current election process is unlikely to deal with. Whereas a place like Italy is actually the one country, the one G7 country, that has actually done the tough work and dealt with those long-term liabilities. So Europe is in a difficult situation, but I don't think it's the Armageddon scenario that often is painted in the media. One, because there's a reason for everyone to stay together, even as painful as it is. There are the resources. The ECB can print an unlimited amount of money. And they are actually taking some of the early steps to deal with the problems that other countries like in the US are not dealing with. So I think the Europe being very bad, completely agree. But being Armageddon, I think, is unlikely. And you really need the Armageddon to get to the global depression. But if you disagree and you think that the Eurozone will split apart, I can almost guarantee with 99% certainty it will make the Lehman crisis look like a warm-up. If the Eurozone splits apart, it will be a global depression. The European banking system will collapse, the global banking system will collapse, and what we saw in 2008 would look like just a trailer. It would be Armageddon. So if you do believe that, I would encourage you to look really outside of the box, and it's things like guns and canned goods in your backyard, because I don't think any asset class would survive that scenario. The next area, which it seems every 6 months comes back into the attention, and clearly here in Australia, the economy is very tied to what's going on in China. A hard landing in China, which I mean a really significant collapse of growth, not a cyclical slowdown to 7% or 6%, but a real crisis in China would be a global game changer. I don't think the world can absorb a crisis in China right now because it is the only engine of growth going on. So what would it take to get a real hard landing in China? I think to get a hard landing in China, you need a banking crisis. You need something global or domestically systemic that is too big for the authorities to deal with. I think that's years in the future. The biggest insurance policy that China has are $3 trillion of reserves. So the massive loan expansion that they made in 2008 and 2009 has to be absorbed by the government. There's non-performing loans that have to be taken on the balance sheet of the central government. But with 40% debt to GDP, they can do that. And with $3 trillion of reserves, they can use those reserves to recapitalize the banks as they have done in the past. So to get to a crisis in China, you would have to envision that the policymakers sit idly by and do absolutely nothing. They have the resources. They've proven in the past they will use those resources if they need to. I do think, though, that the changes going on in China that are more interesting is this last leg of reform. So China, as I'm sure you're all aware, started in the late 70s with agricultural reform, the first phase. Second phase was state-owned enterprise reform. The third phase was opening trade. And this latest phase is opening the capital markets. This, I think, is both the opportunity as well as the vulnerability. This is the phase where China opens its capital markets. It starts to liberalize the cost of capital, starts to liberalize the factor markets. It is absolutely essential for China to do this, to move from middle income to high income. Every country that has gone on that development path, Korea, Japan, Southeast Asia, has gone through that reform. So it's necessary, but it is a great point of vulnerability. And over the next 5 years, as China liberalizes the interest rate market, it will be a vulnerability. And I think that's something that we really need to watch. But if they don't do it, the inefficiencies will grow. So think about, a coal company in China. You get the land for free, you get a government loan at 2%, and you don't have to worry about pollution. Of course it's profitable. What happens if your loan is 10%, you have to pay for the land, and you actually have to put scrubbers in your chimneys so you don't kill everyone? Well, all of a sudden, there's a lot less coal plants, but the coal plants that exist are more efficient. So this is the transition that's going on. China is in the phase of liberalizing the factor endowments, the cost of the environment, the cost of land, and the cost of money. As they liberalize those factor endowments, China will have a more efficient allocation of capital, but there will be less growth. This transition does create some vulnerabilities, as a lot of the projects that were profitable before are no longer profitable. But this is this focus on the quality of growth, not the quantity of growth. To me, this is the big change going on in China that is important, not the cyclical slowdown. Do they bottom in the second quarter or the third quarter? I think that's fairly trivial. It's that big structural change. Can China go from middle income to high income? The only way to do that is the reform of the factor markets, which is beginning to take place today. And I think that is the interesting story in China. So the hard landing in China, I think, is a risk, but I think it's years in the future. If they get this factor endowment liberalization wrong or right, that will be the hard landing scenario in China, not today. So those two panic scenarios, a hard landing in China and Armageddon, I don't think are likely. I do think, though, there are some big structural changes going on that we should not lose sight of. And the first is with regard to China. There is a dynamic in China that we have never seen before. We often think China has an infinite supply of labor, therefore low-cost goods will go on forever. The reality is the one-child policy in China is starting to hit the working-age demographic. And for the first time ever, China has labor shortages. What happens when you have a labor shortage? Very quickly, prices of labor go up. And this just looks at the migrant labor costs. This should be the most substitutable, easily replaceable labor, and it's on a hockey stick trajectory. And certainly here in Australia, I've talked to a number of importers who are seeing, the Chinese don't negotiate prices anymore. It's take it or leave it, same as in the US. As wages go up in China, China's prices to the rest of the world will go up, and the rest of the world will feel the cost of labor pressures in China. So to me, this is a long-term inflationary trajectory that we need to be very aware of. It's being hidden today because of the global deleveraging, but it doesn't mean it's not happening. Once this deleveraging works its way through the system, we have a tectonic shift in China that will have global repercussions, and we need to be prepared for that. So that's the bad news about this change in China, is higher prices. The good news, though, is what happens when your wage goes up. Chinese are no different than Australians or Americans. When your wage goes up, you spend. And so the consumption pattern of China is changing significantly. With higher wages, we're going to see increased consumption. With increased consumption, the Chinese economy begins to rebalance. They import more from the rest of the world, Australia, the US, the rest of Southeast Asia. So it's a very positive aggregate demand shock. Chinese labor in a shortage, wages going up, they import more, they spend more. And this, I think, is a very important global demand positive shock, but it comes with costs, and the costs are higher prices. So this is one of the dynamics that as we start to invest, I think we need to be prepared for. The other big change that's going on is this massive monetary experiment. Never before in the history of central banks have we printed this much money. And I would love to think that it ends perfectly, that there is a free lunch. We can print our way out of all these problems. But the skeptic in me says there are going to be consequences. The massive amount of money that the US, now the ECB, Japan eventually will have to print more, the UK is printing, Switzerland is printing, is unprecedented. The only other time in history that we've seen this amount of money printed, and it's not even anywhere close, was in the mid-90s, when Japan started to print money to deal with its domestic banking crisis. So what they did was printed money, gave it to the Japanese banks. What did the Japanese banks do? They invested in Southeast Asia. Global capital markets are so porous that if you print money in the US, in Europe, that money will flow out of those countries into the rest of the world. So the consequences are very immediate, and capital flows out of the US and Europe will be an important source of investment, but they will also be a driver of commodity price inflation. They will start to drive real price inflation and have long-term consequences. So it's, I think, unimaginable to think that this amount of money being printed will not have global consequences. And to the question, I'm not saying buy silver or gold, but I am saying that I think we need to think through those consequences. So from an investment standpoint, what do? Well, the problem is, with all of these big changes going on, one immediate reaction would be, let's just go really safe, buy US Treasuries. Okay, it's a deep liquid market, but you have a fiscally insolvent government, and you have negative real interest rates. With negative real interest rates almost globally, it's very hard to basically preserve wealth with these inflationary trends coming, given very low short-term yields on a nominal basis, and on a real basis, negative in most cases. Australia is one exception. You can eke out a little bit of return with just cash. But outside of that, there's really no places to even preserve wealth without taking risk. So where do we look for opportunities? I think one of the areas is actually in the currency markets. In the short term, almost impossible to predict, but in the long term, they come down some basic fundamentals. And when we're looking through the opportunity set between the US, the Eurozone, Japan, and the rest of the world, one of the most stark observations we make is that things are of varying degrees of bad in the US, Europe, and Japan. Some are a little worse, some are a little better, but basically it's bad across the G3 world. But that versus the non-levered rest of the world, and that includes places like Sweden or Poland or Indonesia or Malaysia, there are a lot of opportunities long-term because these countries actually have positive growth, they have higher interest rates, they have low levels of indebtedness, and they're not printing money. Quite simply, when a country prints a massive amount of money, they decrease the value of that money through two channels, inflation or a decrease in the currency value. So one of the opportunities is the consequence of this huge policy response is to look for currencies that will rebase against the debasement of the G3 currencies. So one of the opportunities we're finding to be able to preserve wealth is long Southeast Asia, North Asia, peripheral Europe against short euro, yen, and dollar, because the consequences of these policy responses will be felt through a currency debasement. The other area is actually in emerging markets. The world has really gone 180 degrees. 10 years ago, these countries were fiscally irresponsible, high levels of government indebtedness, boom-bust cycles, currency debasement, defaults. Today, the world has really changed quite a bit. And a lot of these countries, through the last decade of really tough fiscal reform, have actually got their house in order. I would say the majority of emerging markets actually are a lower credit risk than most of the developed world. Debt to GDP ratios are less than 40%, whereas in the developed world they're over 100%, Australia excluded. And this to us presents an opportunity to earn actually a decent yield without taking a lot of credit risk. So in the past, emerging markets I think were considered very risky. There was a lot of uncertainty, but the crises of the late 90s actually engineered a lot of change, and these countries have become fiscally a lot more solvent. So this gives us an opportunity. It's not without risk. You're investing in Indonesia or Malaysia or Korea. There are risks. But given their low levels of indebtedness, I think there is an opportunity actually to position for some decent returns commensurate with the amount of risk that you're taking. So in stepping back, where we're seeing opportunities, I think the first question one has to ask is are we in a panic scenario? Should we get out of this room and go to the beach because there's no alternative? If Europe has splits apart, or if China has a hard landing, I think we're in for some really, really, really tough times. If we don't believe that's going to happen, I still think the investment landscape is very difficult, but it's not Armageddon. And in a non-Armageddon scenario, I think there are some opportunities in emerging markets. There are some opportunities in some of the currency markets to preserve wealth over the next 5 to 10 years. It's going to be volatile. The short term, there's no question volatility is going to be there. But over the long term, I think there is a way to preserve wealth, thinking a little bit differently in an asset allocation than we've thought in the past, because the days of a risk-free asset are over. So those are some of the thoughts that I wanted to share with you. I'd certainly be happy and encourage questions to delve a little bit deeper into this. But I think, taking a step back from the pessimism in the media, I don't think it's as bad as maybe it's being portrayed. It's difficult, but it's not Armageddon. And I think in that environment, there are ways to preserve wealth and create wealth, but we have to think a little bit differently than we've done in the last decade.
Well, thank you very much, and good morning, everybody. There certainly is a bit of a whiff of panic in the air at the moment, and it does reflect all of those issues that Michael has just talked about. Will the Eurozone implode? Will the US drive off the edge of that fiscal cliff that's looming there for next year? Is China in for some sort of hard landing or not? There are clearly plenty of reasons to worry. All the risks do seem to be on the downside, but I think in that sort of environment there is this tendency to focus only on those risks and to ignore some of the positives that are actually still in play. And I suppose in that theme, it's not surprising that one of the common lines you hear out of Canberra, out of the Reserve Bank these days, is it's almost as everybody here thinks they're living in Greece right at the moment. Now, because there are all those uncertainties though, and all those risks, as I say, to the downside, I always like to start with our disclaimer. There it is. Moving right along though. The fact is, when you step back from the headlines and look at the Australian story, there are still plenty of things to like there. I've just picked out some of them on this couple of charts here. Well, chart on the left, we've just been through a couple of rounds of Olympics, Paralympics and so on, so we all know it's about the medal tally, how are we going compared with the rest of the world. Well, the chart on the left-hand side there tracks our growth performance compared with all those countries that we regularly like to benchmark ourselves against. Well, the red line there's Australia, and as you can see, more or less since that point that Lehman's went under back in 2008, it's been a case of onwards and upwards, occasional wobble along the way, but very clearly it's a much better growth performance than many of those other countries that we like to compare ourselves with. Equally, the chart on the right-hand side, what's our labour market look like compared with the rest of the world? Well, we're looking very good there as well, as you can see. And I could throw into that mix the fact that inflation in Australia at the moment is running at about 2%, so the bottom end of the Reserve Bank's target range. Our financial system is in very good shape compared with many others right at the moment. And when you look ahead, what also stands out is the general expectation is that outperformance, both compared to our own history and compared to other countries, is expected to continue. And on this particular chart here, I've collected the forecasts for economic growth from a range of forecasters for Australia. So the consensus amongst Australian economists, the government, the Reserve Bank, the International Monetary Fund, the OECD, whoever we can find. Well, if you look at those green bars, there's a pretty common theme across those forecasts for the next few years, and that is that the Australian economy is going to grow somewhere in the low threes, or around about sort of trend type or average type growth from an Australian perspective. Now, it may be a case of great minds think alike, or perhaps fools never differ. We'll find out the answer to that over the next few years. But certainly, if in 2 years' time we look back, and this is the sort of growth outcome that we've had, I think it'll be seen as a pretty good one overall. Of course, it's also worthwhile reviewing all of the assumptions that underlie those trend-type forecasts for Australia, and I've listed them all on the chart there. Michael's talked about a lot of those. They are mainly from the global side. But from a domestic perspective, the other risks worth thinking about there are, well, will the mining construction boom run its full course? We're going through pretty intense fiscal consolidation in Australia as well at the moment. What impact will that have on the economy? And just how is the Australian household story going to play out? Plenty of domestic uncertainties as well on top of those global issues that we're facing. One critical point of differentiation, I think, with Australia when you're thinking about those risks, of course, is that we're actually in a pretty good position to deal with them if they actually do appear in reality. We have a lot of policy firepower left, and we can use that if it turns out to be necessary. And again, just to make the point there, chart the left-hand side, looking at policy interest rates around the world. Well, you can see Australia there, the pink line. Well above zero, plenty of scope for rate cuts. Many other countries where it is close to zero, very limited ability to use that sort of traditional policy arm further. The chart on the right is a variation on the one Michael used. I've added on Australia in this case. Looking at government debt here, the pink line on the bottom of that chart. Well, the government is hell-bent on producing a budget surplus this year, and if they achieve that, then it means that government debt in Australia is peaking right now at about 10% of GDP. And as you can see on the chart, that's a fantastic number compared with other countries, and certainly the sort of number that many policymakers in Europe and elsewhere would probably saw off their left arm to have. What it means is the same: scope to cut rates, scope to use fiscal policy if necessary, and we've seen examples of both in the last few months. So policymakers here aren't afraid to pull those levers if it turns out to be necessary to make some significant changes. But when you go back to that earlier chart, though, about the assumptions underlying that trend growth story, most of them do have a Chinese or Asian flavour about them when you're looking at it from a purely Australian perspective. The point I'd make about China in particular is that there is now a lot of policy stimulus being applied in these economies. It's not yet evident in the data, but it's there. It is working its way through the system. And in terms of the two charts that I follow most closely when I'm thinking about the China story in particular, well, it's these two here. The one on the left is looking at monetary policy in China. We think the best indicator to look at there is what they call their reserve requirement ratio, which is the blue line on that particular chart. Now, why I plotted it was that blue line goes up, policy stimulus is being added into China. And as you can see, to the extent that line has gone up, a fair amount of stimulus is actually now in place, with more to come, we think. The reason I follow that one, though, is it's got a very nice leading relationship with the direction of Chinese growth in this case, the red line on that chart. And what it's suggesting is we're not at the bottom of the Chinese cycle just yet, but certainly we'll be expecting to see some stronger looking numbers as we move through the rest of this year and into next year. Now, of course, the only question you hear about China really these days is about iron ore. Even the taxi driver on the way from the airport last night wanted to talk about iron ore prices. Well, I could take the red line off that chart and put on Chinese steel production, and you get pretty much the same result. When you look at fiscal policy, the chart on the right-hand side there, it's kind of the same story. The darker line there, it shows you a momentum indicator that we construct for Chinese infrastructure spending. This is the sort of steel-intensive part of the story. As you can see, that momentum indicator has popped back above zero for the first time in a while. So there's a positive momentum in that China infrastructure story. Over the weekend, we saw the announcement of a lot more infrastructure spending being announced in China, not from just the central government, but also from some of the big cities in China. Now, in this case, I have added on the green line on that chart, which is iron ore prices. And again, you can see the sort of broad correlation that's there over time. This evolving sort of fiscal backdrop is one that we think will limit the downside to commodity prices from here. So it's not again to say that prices can't fall further. They probably will, but it's not the Armageddon type scenario that we all worry about right at the moment. And it's also important to remember that not all commodity prices are actually falling at the moment. We talked about gold right at the start. Well, gold prices are obviously higher. But the other ones that are important for Australia, the chart I show on the left-hand side here, is that a lot of those agricultural prices have actually increased quite significantly. Now, they're up, of course, because of drought in key producing parts of the world, the US and elsewhere. There's been a very sharp increase in those prices. And while we don't like to benefit from other people's misfortune, the fact is we're probably going to have quite a decent grain crop in Australia this year because of conditions here. Of course, lots of production and a decent price for it. So that part of the commodity story actually looks better than it did just a few months ago. There is one other aspect of that food price story that I'd like to play out here, and that relates to the importance of food in most countries, especially the developing and emerging economies. Food's a large part of the story there. A lot of spending goes on food. It's a big part of the consumer price index in those countries. So, of course, this higher global food price story is going to be reflected in inflation there. And so one of the risks that's worthwhile thinking about here, of course, is that if inflation's picking up in some of these emerging economies in Asia and elsewhere, then there is a risk that will limit their ability to keep pushing through this policy stimulus that they have put in place so far. The other and rather more unusual possibility, I suppose, is what it might mean for broader market uncertainty. The chart on the right-hand side there, it shows you the correlation between food prices on the vertical axis and the number of civil unrests or major civil unrests that occur around the world. Now, there are actually people that collect data on this. I've turned it into a chart. But the message from this chart is that big increases in food prices often go hand in hand with big increases in civil disturbances and the like. Quite often these are in countries that are important for reasons like oil and the like. And obviously in the current environment, anything that raises just general uncertainty about the global story is something that might weigh on financial markets as well. So certainly watching food prices, I think, will be an important part, not just in terms of what it means for the economy, but for markets as well. Now, the question I get asked most about at the moment, of course, is, well, is the resources boom over? Part of the problem in trying to answer that question, of course, is, well, what do we actually mean by resources booms? And when you think about it, it's really a couple of different factors that have come together here. There is the price part of the story, but there's also the mining construction part of the story that's been very important for Australia. And when you look at the price part, well, it's pretty clear looking back now that commodity prices peaked in Australia back in the September quarter of last year at what were about 150-year highs at the time. And they've obviously come back a fair way since then, and maybe with more to come. And of course, that's just freshened up the fear that's been a long-running fear in Australia that this whole commodity story is too good to last, and that every boom is followed by a bust that just basically takes you back to where you started from. And you can see why people worry about this when you look at the history. This chart here, it shows you the history of terms of trade booms in Australia over the last 60 years. So terms of trade, really just economist jargon for commodity prices. I've started all these booms at 100. You can see the run up, and equally you can see the run down that has pretty much left us where we started. And I think that explains all the fears about this story from an Australian perspective. Now, it's always a dangerous thing to argue that this time is different. Economists do it all the time, and quite often they're wrong. But I don't have to do it this time because this time is already different. Same chart, I've had it on the red line there. That's the current terms of trade or commodity price boom. This one is different because it's already run on for far longer than any other boom, and obviously gone a lot further than any other boom that we've ever seen. Equally, you can see the drop-off that's occurred at the end, and where we're sitting right now, well, commodity prices are still exceptionally high by the standard of any cycle that we've ever seen, and it's hard to imagine a scenario where that red line can go all the way back to the bottom of that chart. The point I'd make about this price story, though, is from an Australian point of view, it's really an income story. And as long as prices don't fully retrace all the way back to 100, then there is going to be a lasting benefit left for the Australian economy in terms of where incomes are sitting. And the chart on the left-hand side here just makes the point. The blue bar, it shows you the increase in production or GDP per person over the period that this commodity boom has been running. Well, it's up by about $13,000. But over the same period, though, the green bar there, the income generated by that production is up by more than $19,000. That's pretty unusual because income and production generally move at the same rate. But that $6,000 or so gap between those two bars is a measure of the extra spending power that everybody has in this room and out there per person per annum, courtesy of where commodity prices are sitting right now. And even if prices drop a little bit further, a lot of that income boost will remain. Incomes will be higher in Australia than they would have been without the commodity boom, and spending levels will be higher on the back of that as well. The mining construction part of the story, I think, is probably the bigger risk in the short term for Australia. There is a huge mining construction boom underway, as everybody will know. But of course, we've seen a few indications in just the last few weeks that some of these big projects are either being scaled back or are not going to go ahead. Olympic Dam, Fortescue, and the like. But the point I'd make about this mining construction boom is that most of it is actually in projects that have started. They're very big projects, which mean they're going to run for a number of years. And because they are big projects, they're going to have a sizable economic impact as well. Now, we've combed through pretty much every mining project we could get the information on, looked at the time frame and size of the spending and so on. It was a lot of work, and all we got out of it in the end was the chart on the right-hand side, so two coloured lines, so to speak. But this is sort of pretty critical to that story. If you look at the blue part of that chart, well, that's the projects that are underway, so the ones that almost certainly go through to completion. If that's the only thing that happens, then the mining construction boom will peak at about 2013, 2014. The red part of the bar, well, that's where the negative news headlines are coming through at the moment. It's those projects that haven't started, that haven't been signed off on the board, but potentially could go ahead. This is where the cancellations and delays occur. Now, if they were to run through in the usual sort of timetable, then we'd probably push back the turning point for this mining construction story that's been a huge support under the Australian economy over the last few years by another year. Either way, the end of this mining construction story is in sight. It will drop away pretty quickly, as you can see on that chart. And there is a big growth pothole developing in the Australian growth story on the back of that. So we will be looking for alternative sources of growth. Now, there is one obvious one. Hopefully all these big holes in the ground will generate some production and resource exports, but it won't be enough. The answer for the rest, though, I think will largely depend, again, like much of the Australian story, on what is happening in Asia. And just to pick up on some of the points that Michael made, one of the big features of development over the next few years will be the growth in the middle income group in the Asia-Pacific region. This chart here just shows you some pretty standard projections about the size of that group. What we're basically talking about is a group that's going to increase from about 500 million middle-income consumers now to about 1.5 billion by 2020. So a lot of people with a lot of money to spend, and we do know from the history of these things what do middle-income populations like to spend their money on? Well, there's a whole list that I've put there. They want bigger and better quality houses. Well, that's good for the current construction part of the story. They want more and better quality food, so there's certainly part of the agricultural story there that we can benefit from. They like access to education, and like everybody else, they like to go on holidays. These are two big sectors in Australia that have been hurt in the current environment. And of course, there's also an ageing aspect in this story again, as Michael referred to. Older populations, what do they want? Well, they want access to health and also to financial services, including pension schemes and the like. This is an area where Australia obviously has a lot of experience. I would just say quickly that this is not kind of pie in the sky stuff. It's already starting to happen. And I've just picked out a few examples here. So, the first chart there, student visas. Well, already about half of the student visas that get issued in Australia to people from Asia and from India. The middle panel, The people arriving in Australia largely on holidays, well, the fastest growing component is already people from China and India again. The more intriguing possibility here, though, I think, is the consumer durables story, again, that Michael referred to. You can imagine a scenario here where China ends up consuming most of what it produces, and maybe they even have to start importing manufactured goods. So opportunity for manufacturers everywhere there. This is something that most people laugh at because they find it hard to imagine that Australia could actually produce something that China would want to import other than iron ore and coal and the like. There is a precedent here, and it's the commodity story again. It wasn't that long ago that China and the rest of Asia was actually our biggest competitor on commodity markets. The final panel there, the first set of bars, it shows you net exports of commodities from Asia in 1970. The other bar is the current situation. So we've moved from a situation where Asia was a big net exporter to one where they now use everything they can produce themselves and everything we can dig out of the ground and send over to them. So I think there's a precedent there about how the manufacturing story might play out. Now, just those sort of changes, of course, would obviously be a lot easier if the Aussie dollar was lower than it is right at the moment. And so that path for the Aussie dollar will be pretty important when you're thinking about this particular part of the story. And obviously, the Reserve Bank has been under a lot of pressure recently to think about ways of lowering the currency. Well, will they do it? Probably not, we think, but you can see why people worry about it. Reserve Bank describes interest rates in Australia as slightly below average, so implying there's some policy stimulus there. But if you throw in the currency into the mix and look at monetary conditions overall, as this chart here does, well, you can see that conditions overall are still well above average. This chart's also useful because you can then work out, well, what sort of drop in the Aussie dollar do we need to see to really change that story? The answer is that you'd need to see it drop by 18 to 20%. We need to get the currency down to 89 cents. And in the sort of backdrop that Michael has described, that's going to be extremely difficult to do. And the first thing that will happen in Australia's case is that inflation would pick up as a result. This is the key reason why we think the Reserve Bank won't pursue any sort of action to try and lower the currency. So we need to be all prepared, I suppose, for it to be a high currency story for an extended period. Thank you very much.